Today, November 15th, 2025, Bitcoin consolidates its gains after Congress finally passed the budget bill. We analyze why the Trump administration is pushing to introduce crypto collateralized mortgages. And Sam Callahan from Orange BTC explains the main drivers of Bitcoin's price in this political normalization scenario. Crypto markets are showing signs of stabilization in this second week of November. After the U.S. Congress definitively broke the political stalemate that had kept the government in a shutdown for weeks. In today's session, Bitcoin maintained a 1.5% increase, stabilizing firmly above $15,000, while Ether moved sideways and XRP continued its run with a further jump of 7%. This period of relative calm follows the final approval of the funding bill, which received the green light with a comfortable margin after several Democratic senators decided to support the compromise despite the absence of ACA subsidies. The measure now guarantees the reopening of federal offices until the end of January, allowing for the reinstatement of thousands of public employees laid off during the crisis. Meanwhile, data from the University of Michigan survey confirms how prolonged political uncertainty had driven consumer confidence to its lowest point in 3 years, with evident repercussions on all financial markets. On the corporate front, Etero's stock benefited from the renewed optimism, posting a gain of over 8% after reporting surprisingly positive quarterly results, driven mainly by renewed interest in digital asset trading. Despite this good moment, the stock remains in negative territory since its market debut last May, in a context where real estate values remain near all-time highs and mortgage rates continue to be an obstacle for many buyers. The U.S. administration is exploring innovative ways to integrate digital assets into the housing credit system. Several analysts have recently published in-depth studies on the functioning of mortgages collateralized by crypto portfolios and the potential implications for the residential sector. It's clear to everyone that access to homeownership is becoming problematic for younger generations. The median price for purchasing a home in the United States remains steadily above the psychological threshold of $400,000, a level that represents a significant hurdle for many families. Confirming this trend, the recent survey by the National Association of Realtors highlighted that the average age of the first-time home buyer has now exceeded 40 years, an unprecedented figure reflecting market difficulties. This very situation has prompted several players in the crypto sector to propose alternative solutions based on the valuation of digital wealth. The Trump administration seems to have seized this opportunity, so much so that last June, Bill Pai, director of the Federal Housing Finance Agency, had formally requested that Fannie Mae and Freddie Mac develop concrete proposals to include cryptocurrencies among the assets evaluable in mortgage applications. Although some private operators already offer similar services, the entry of the two mortgage giants, which alone acquire about 70% of American mortgages, would represent an epochal turning point in the relationship between crypto and the real estate market. Two sector experts consulted explained that integration could occur through a process not unlike the current asset valuation. In practice, the applicant could simply add their digital portfolio to the financial dossier, exactly as happens today with bank accounts or securities. I personally doubt it will become a decisive element for loan approval, considering that banks traditionally prefer less volatile assets, but it could make a difference in those borderline cases where every asset counts. Fannie and Freddie will necessarily have to define conservative parameters for valuation. Imagine a client declaring $10 million in Bitcoin. The agencies will have to establish what percentage of that wealth to actually consider in the credit assessment, probably applying a significant discount to compensate for high volatility. The initiative has nevertheless raised concerns among Democrats. A group of 5 senators, including prominent names like Elizabeth Warren and Chris Van Hollen, sent an official letter to Pai requesting detailed clarifications on the directive, emphasizing how the fluctuating nature of cryptocurrencies could introduce non-negligible risk elements into the mortgage system. It's right to worry about the stability of the mortgage market, commented one analyst. Just think about what happened in 2008. However, cryptocurrencies are unlikely to trigger a systemic crisis, provided they are correctly weighted in the risk assessment. The key will be to see how these valuation parameters are structured. For her part, Republican Senator Cynthia Lummis has presented a bill to institutionalize the process through the 21st Century Mortgage Act, arguing that this innovation could help all those families who, despite having accumulated wealth in digital form, currently find themselves excluded from traditional credit. Demographics tell us that most crypto holders fall precisely within the demographic of potential first-time home buyers. Today, buying a home has become almost impossible for them. Despite having significant wealth, we simply want to allow these assets to be considered in the calculation of financial capacity. According to observers, however, the legislative path remains uncertain. The government shutdown has already slowed the process of many crypto-related proposals, and with midterm elections on the horizon, lawmakers might prefer to focus on more traditional issues. Shifting focus to the markets, we interviewed Sam Callahan, Director of Strategic Research at Orange BTC, to understand the prospects for cryptocurrencies in this new political framework. Sam, how do you interpret this phase of price stabilization, and how much does the political variable still weigh on investor sentiment? Thanks for the opportunity. I'd say the political situation remains an important factor, but not the only one. The Federal Reserve has recently reversed course on monetary policy, and this has positive implications for global liquidity. When the Fed announces the end of quantitative tightening and starts cutting rates, it creates a favorable environment for unconventional assets. If we add the persistent federal deficit to this, we understand why Bitcoin as a safe haven asset and protection against monetary debasement is gaining credibility among institutional investors. Does this return of volatility represent a threat or an opportunity for companies specializing in crypto treasury management? Every market correction tests business models, but phases of excessive optimism often create unsustainable valuations. Today, multiples have normalized, and many listed companies are trading close to their net asset value, representing potential investment opportunities. The real value of these entities lies in having created access channels to Bitcoin for those large investors who, due to regulatory constraints, cannot directly hold the underlying asset. Compared to the beginning of the year, Bitcoin has outperformed Ether and most altcoins. Could this leadership consolidate in the coming months? Absolutely yes. Bitcoin is progressively distinguishing itself as the only truly institutional cryptocurrency. The differences are substantial: proven security, superior liquidity, non-experimental technology. Recent events have demonstrated how during stress phases, many alternative assets suffer from chronic illiquidity, with sudden crashes that make them unsuitable for large portfolios. Bitcoin doesn't have these problems. What are the less obvious catalysts that investors should monitor? We often overlook Bitcoin's global dimension. While we discuss the Fed here, 85% of the world's central banks are already implementing expansionary monetary policies. In many emerging economies, currency devaluation is a much more serious problem than in the United States. Our expansion into Latin America responds precisely to this need, offering protection from monetary depreciation through access to Bitcoin. Some analysts, like Cathie Wood from ARK Invest, have recently revised their long-term Bitcoin forecasts downward, citing competition from stablecoins. Do you share these concerns? Not in the long term. Stablecoins are indeed dominating the payment segment, but Bitcoin is finding its primary vocation as a store of value. It's significant that Cathie Wood only moderated her estimates, still maintaining extremely optimistic targets. Stablecoins remain fiat currencies after all, and therefore subject to depreciation over time, while Bitcoin preserves purchasing power. Over the next 5 to 10 years, we will see Bitcoin consolidate as a safe haven asset, while payment applications will mature over a longer horizon. This concludes our analysis for today. We'll see you tomorrow for new updates on the world of cryptocurrencies.